Good morning and welcome to Bob's Coffee Chat. It's my weekly Zoom presentation where we have presentations every week with a featured speaker that talks about how to thrive and survive, or should I say survive and thrive in the era of Corona. And today I am your speaker and I will be doing the Coffee Chat presentation. So my name is Bob Bednarz and I am with Guarantee Mortgage. And I am a residential mortgage broker. And I like to call myself your lender for life. And as I get my slideshow going here, I am going to let you know a little bit about me. I have been a mortgage lender since 1992, and I built my reputation on referral marketing. I defy the notion that mortgages are transactional one-time events. And I consistently receive business by building business through referrals and building relationships. I have a bachelor's of science degree in business management from San Francisco State University. And I applied my skills, my management skills as co-owner of Slade Limousine Service in the 1980s. And I switched to lending when double-digit mortgage rates turned to single digits in the 1990s. And I've been riding the long-term trend of low mortgage rates ever since. And so today, you give me a second here. I'm going to get my slideshow going here. There I am. Okay, so today I am going to talk about why buy a home if renting is cheaper. And it's kind of counterintuitive to what I do because I do mortgages. I don't make money off of convincing people to rent their homes, but it is a big financial decision and there's a lot involved. So that's what I'm going to talk about today. And first of all, I just want to talk about the myth of being a homeowner in this country. A recent Fannie Mae survey shows that Americans think that now is a good time to buy a house. Turns out Americans always think that. My entire life, and presumably your entire life, living here in the United States anyway, we have been told that the American dream is home ownership, and that home ownership in the long run benefits the national economy. But is it good for Americans to own a home? You know, ever since President Abraham Lincoln signed the Homestead Act back in 1862, subsequent US presidents from Herbert Hoover to Lyndon Johnson to Bill Clinton to George W. Bush have all stressed that the road to financial security and stability is best achieved by becoming a homeowner. So that kind of came to a crescendo back around 2002 when we had the height of the craziness on Wall Street and people were buying houses extremely easy with no money down, no income verification. There was a joke around at the time that if you put a mirror up to your face and breathed on it and there was condensation, you qualified for a mortgage just for being alive. That's how crazy it got. And so there were no money down loans, and then there were loans that were extremely popular called negative amortization loans, where they started out with like an interest rate at, let's say, 1.95%, but you actually accrued your interest at like, let's say, 4.95%. So you'd make a minimum payment based on a 1.95 rate, and your payment was actually accruing at 4.95%. So that difference of 3% was added onto your principal balance instead of subtracting from your principal balance. And you could do that month after month after month. So it's conceivable, and it happened, that people, let's say, that started out with a $400,000 mortgage ended up with a $500,000 mortgage when it came time to pay off. So that's where this whole meltdown with the mortgages came in. When banks came to call on these loans and people couldn't afford to pay them back, it just was the big fireworks that started the big mortgage meltdown back in 2006, 2007, 2008. And it just made the big Great Recession and the biggest financial crisis we've had since the Great Depression. Since then, regulators have gotten control through the CFPB, which is, excuse me, I'm missing what the acronym, but there's the CFPB, which controls and regulates the mortgage industry as well as the financial industry and makes it a little more tougher to see that or to be able to qualify for a loan. So it takes more than just breathing on a mirror to get a loan. So let's talk a little bit about what a homeowner really is. Many people are fooled into thinking that signing your name on a lengthy mortgage agreement makes you a homeowner. The reality is the bank owns your home until the mortgage is paid off in full. Just like how a bank can repossess your car for missed payments, the bank can also repossess your home for missed payments through a foreclosure. So you got to realize that if you're going to buy a home, it's really a long-term type of investment. And today our economy relies on labor mobility. So you need to have people to be able to move to where the activity is, to move where the jobs are, to move where the wealth is. And if you own a home, it's very hard to move, especially if you own a mortgage. So think about it today. If you actually own a loan home, if you want to buy a home now, and you got to do it the demand for it is incredibly high, and you've got to be able to perform. Like if you get your offer accepted, you've got to be able to close very quickly these days, like within 2 to 3 weeks. And if you can't afford to have your current mortgage in your current home and get a new mortgage on a new home without selling and paying off that old mortgage, you're saddled with a mortgage. And that's happening a lot, especially with the Great American Reshuffle. People are actually leaving the Bay Area to go places that are cheaper to buy. Let's say in like Boise, Idaho, or Albuquerque, for example. But they're having the same problems there. So, until you can actually figure out how to get rid of that debt on the home you own here, how are you going to buy over there? So just, something to think about. The economy isn't necessarily benefiting from you owning a home. It's benefiting you more, your availability to go where the money is. And if you think that owning your home, if you don't own your home and you're renting your home, you're actually paying your landlord's mortgage, well, that is correct. But think of all those mortgage interest payments. Even if they're tax deductible when you own your home, you're going to still be paying the bank rather than your landlord. And you might think that maybe Bank of America is a more worthy place to send your money than your landlord, but that's not necessarily the case. So, why bother a home, especially if renting is cheaper? This is the question most of us will have and will likely face in our lives. So do you really have to buy a home? And after all, buying a home, as I've been mentioning, is not necessarily for everyone, and renting can be cheaper. So let's look at the statistics and kind of get into the meat of it. So we're in a very interesting market right now because of COVID-19. Rents actually went down on average in the Bay Area about 10%. And that's after years of like them going up, going up, going up. But now it's made rent pretty affordable, at least affordable than it was a year ago. And if you look at the survey on the screen, the median rent for, let's say, the San Francisco, Oakland, Hayward area, the metro area, median rent's about $2,801 a month. Year over year rent has gone down 6.1%. And if you look at like studio apartments from 2020 to 2021, that median rent of $2,305 a month actually went down 12.5% from the year before. A one-bedroom apartment has gone down to $2,582. That's like 8.2% lower than the year before. And a two-bedroom home and has gone down to $3,311, and that's like 5% lower than it was the year before. So are rents going to start going back up again? Well, they've been going up in areas that are really popular, let's say like in Boise, Idaho, and Albuquerque. But I talked to a friend of mine just the other day. We had coffee, and he leases out properties for Brookfield Properties, which is south of Market. And last year, they not only gave really good deals like this on the rents, but they also give the current tenants an opportunity to lower their current lease as well. And so what about this year, I asked him, now that COVID kinda is getting a little under control and people are feeling more comfortable about living in apartments in San Francisco. He said, yeah, they're going up, but not really more than about 1 or 2%. So they're kind of staying in this range, at least for Brookfield leasing and at least for that particular section of South of Market where they lease. So it's still some opportunities for renting a home. But what about a single family home? Should you buy a home? Everybody wants to get that 3-bedroom, 2-bath home with a yard for the kids and the dog, and a place for you to get away from the rest of the family if you want to, you want a den to veg out in. So let's look at the figures on that. Average rent for a single family home, let's say in Corte Madera, is $4,970 a month. Now, if you wanted to buy that home, the median list price for that home is $1.4 million. So let's look at the difference in if it's cheaper to rent or buy this particular home. Rent looks cheaper because at $49.70 a month, well, let's look at the scale, look at the chart on the right. We have a purchase price of $1.4 million, and you've got a down payment of, let's say, $280,000. That's 20% down. That's a loan amount of $1.12 million. At today's average fixed rate of 3%, your principal and interest payment for that home is $4,021.97 a month. That on the principal and interest payment is cheaper than the monthly rent, but you got to remember, you've got to have homeowners insurance, and you also have to pay property tax for that home. So when you add the homeowners insurance of $280 a month and the property tax of $1,458 a month, that total principal and interest and taxes and insurance comes to $6,460 a month. So it's 30% cheaper per month to rent that home for $49.70 a month than to actually own it for $64.60. But what about the time value of money? So when does it become cheaper to buy? Realtor.com has got a great buy versus rent calculator that imputes all sorts of things like the current interest rate, the current value. It has a tool that tracks rent versus buying using actual market data through its website. And it includes factors like inflation. And so on this very sophisticated calculator, for buying, it shows the total costs of buying, your closing costs, your down payment, and compares that total value of money that you would be spending over time, minus the potential value you might receive if you someday sell the property. So it's taking into the fact the amount of money that you would gain from the appreciation when you eventually sell. And so if you look at this on this timeline, when I inputted the Corte Madera at the desired home price of $1.4 million with the down payment of $280,000, and I compared it to the monthly rent of $49.70 and even included monthly renter's insurance at $65 a month, the break-even point was 4 years. So if you look in the left-hand column, you can see the benefits, the economies of scale, where rent is cheaper, very much so in the beginning first year, and as time goes on till the 4th year, it becomes a break even. Whereas after 4 years, the line for buying goes up because as time goes on, your home's going to appreciate and you're going to get the value of your home back as profit when you sell the home. So in a nutshell, year 4 is the break even point. And if you look, so if you're one of those people that's in the mobile economy and you don't know how long you're going to be living in your current home, and you may end up going to Austin, Texas in a couple of years because you're in the tech industry and that's what you guys do, then maybe renting is cheaper for you. Because by year 2, if you've rented, your buying average cost, net cost is about $8,192 a month. That's the buying average net cost over time, as you factor the time value of money. Renting stays flat at $51.71 per month when you included that renter's insurance with it. So by renting, instead of spending all that money to buy, after 2 years, you saved yourself $72,515. That's $3,021 a month. And that's how much you save by renting. However, if you're there long-term, you're buying in Corte Madera to get in the right school district, you got a single family home with 3 bedrooms because you're newly married and you're having your first baby and you plan on having more and you're going to be there for a long time, then if by year 6 you're still there, buying ends up being cheaper. Your buying average net cost over time, as you remember, you're taking into the fact the appreciation you would get if you sold at that time, After factoring in those initial closing costs and the cash to close, your net cost per month for buying through year 6 would have been $4,652 a month. Again, renting stayed consistent at $5,171, and that's if your landlord didn't raise the rent for 6 months. But still, let's say he didn't. You saved yourself $79,293 by buying. That's you save yourself $1,100 a month. And as you saw from that scale back there, the longer you stay in the home, the less the more you're gonna save by buying. Maybe I'll stop the screen share and see if I can actually log myself onto the actual site. Here it is. And I'm gonna put it in the chat too, if you guys wanna like go along with me or even do your own calculation. I just put in the chat the rent versus buy calculator that's on realtor.com that you can log into. But again, let me go back to the screen share. Give me half a second. And I'll show you how it works on the, there we go. I just want to make sure you all had a chance to do it with me. So when you go on there, it's going to pop in a city. You can put any city you want. Here, I'm going to go back in. You do it by zip code. So 94925 is Corte Madera. Boom, you pop it in there. The desired home price pops up at 1.4 million. The down payment, it comes out at 165. I had it at 280,000. Oops, not 2.8 million. And the desired rent we had was $49.70 a month. And it pops up that renter's insurance again. And advanced options, you can see this, all this stuff that figures out the mortgage interest rate, your closing cost, your property tax, your maintenance, your capital gains after you sell it. It's a very sophisticated calculator. So when you put that information in here, when I calculate it, it actually comes out again, coming out 5 years, but I think it's because if you look there on year 4, your renting cost is $54.54 and your buying cost is $54.65. So that's technically the break even though when I pop it on here, it's showing 5 years, but 4 years is closer to the deal. So that's where you can find lots of good information on here. I'll do another one real quick. I'll do my zip code 94114. Okay, desired home price. Ooh, I think that's not right, but we'll go with it. Let's just go. And the rent in my neighborhood is probably a lot more than $3,500 a month, but maybe not. This is what it's coming out here. So let's calculate my neighborhood. It's saying 9 years. It's cheaper to rent for 9 years based on this information. If I get a home that I can buy for $1.3 million, $395, but I can rent the same home for $3,500 a month. But if that rent goes to like $5,000 a month, you can play around with this numbers based on information that you have in your neighborhood. All of a sudden, there it is, the 4 years again. So that's what's nice about this calculator. I encourage everybody to use it and find out what is better for you in your neighborhood. So again, you've got other things to think about as well too. You've got to think about rent going up, and right now it's not too bad, but home prices, oh my God, in the real estate market, it has gone up 16% year over year. It's huge. So, and with the opportunity of rent going down now and home prices going up later, it's crazy. So let me get a little back to focus here. So what I want you also to think about is the fact that if you buy, like if you want to be in the home for long term, and you're not going to stay just for 2 years, you can stay for 6 years, and you're looking at this calculator, if you buy now, if you don't buy now, then when will you buy? So that's another factor. Let me see if I can get in full screen here. Sorry, I'm just kind of custom slideshow. Give me half a second. There we go. So the reason I bring this up is right now the average 30-year fixed rate is 3%, and basically, that's pretty much because our Federal Reserve is just pretty much propping up the interest rate market. It's because of the bad economy and stuff. I won't go into the details of it, but if the Fed wasn't going to be doing their buying a mortgage-backed securities to buy mortgages, our rates would be going up right now. And they're talking about tapering, what they call quantitative easing. So if they push back and not buy so many mortgage-backed securities, just technically, if they do, if you hear that in the news, that has the potential for rates to go back up. And COVID-19 in the economy, we don't know what's going on. Bottom line is, inflation is what's going to drive interest rates up. And so, the inflation's up now, but they're saying it's transitory. But I don't know about you, but when I go to the restaurant and I go and see that the prices that I'm paying right now is a lot more than I paid a year and a half ago. I don't think those prices are going to go back down anytime soon, but I'm not going to argue with the Fed. But I do know that if the Fed goes up and rates start going up again, that same home that I showed you, for example, that $1.4 million, you have to earn at least $15,000 a month to be able to qualify to buy a home at 1.4 million with 20% down. But if you look at this chart, 3 years ago, just 3 years ago in 2018, the annual average mortgage rate for the entire year was about 4.5%. And right now it's about 3%. So that same $15,000 that can buy you a home in Corte Madera for up to 1.4 million, if your interest rate was 4.5% instead of 3%, that same $15,000 would only buy you a home up to 1.2 million because it's going to be more expensive for your mortgage payment. So if you decide to buy, now might be a better time than waiting to see if the rates are going to go up any higher. Just something to think about. And I just think I pretty much got the gist of it on that. Except you've got to think of your other considerations as well. It's a lot more than financing. Like I've talked about before, we're in the mobile society. There's the career choices, the great American reshuffle. Are you going to be short-term? Maybe it's better to rent. If you're going to be long-term, maybe it's better to buy, especially if you're putting down roots and raising a family. On that note, please be wary of using your home as a bank. Before the not so much now, but before the mortgage meltdown, I had people that would be refinancing their home to pay off credit card debts, to pay off buying a motor home or a boat. And, they just spend, and then they use their home as the bank to do a cash out refinance to pay it off. So just a little warning on there, because if you buy your home with that $1.12 million mortgage, and then when you go to sell that $1.4 million home at $1.8 million and your mortgage amount is $1.6 million, you've actually lost money because you've been spending it as you go. So please don't use your home as your bank if you can. But there's other considerations as to, like the slide attests to. I'm going to bring up the example about your retirement. So retirement is tricky because if you don't own your home now and you're still a renter and you're close to retirement age, that can be scary because you don't know what your landlord's going to do without having that security of where your housing is going to be. One way you can do that is, well, think about it first, because you're earning less and you've got a fixed income and you technically get poorer over time with things like inflation. So how do you keep yourself from managing that? So if you're worried about renting, you can get a reverse mortgage if you buy a home. What that means is a reverse mortgage is like that negative amortization loan I told you about earlier. But the nice thing is you don't have to make mortgage payments. And here's how it works. You put your down payment down, you get a reverse mortgage loan. All you pay is property taxes and insurance moving forward. What the mortgage does is, instead of paying that, the interest you accrue on that mortgage gets built up over time. So let's say your mortgage rate's at 3%. The interest at that 3% gets added on to that principal balance year after year, or month after month after month. So what that means, though, is it's not a bad thing if you have equity in your home, because you're using that equity as a way to finance your retirement. And you get to stay in your home. And when you go sell your home, you're going to have to pay a higher mortgage payoff, because your $500,000 mortgage, let's say they started, would be $600,000, but your home would have appreciated and you should have some equity back. And even if it got to be a bad real estate market, because reverse mortgages had a bad rap early on, because when the bank went to sell the property and there was no equity left, they would foreclose on the buyer. I don't want to get in a lot of detail on it, but there's measures in there and regulations to keep you from the bank stealing the home away from you on one of these mortgages. But if you've got kids and they're looking at your equity in your home as their retirement, that's something you would have to consider with your family. Also, if you become incapacitated where you can't live in the home anymore, then you either have to sell or refinance out of that reverse mortgage, because one of the requirements is you have to live in your own home. If you have to go to assisted living or long-term health care, it's probably good to get a long-term healthcare insurance policy to help you in that situation. For example, I have one policy I got like 9 years ago, or even longer than that. And the price on the premium went up, and I went back to my insurance agent and said, hey, this went up. I didn't think it was going to go up. And, I almost was going to get rid of it. But she went and said, and came back to me and says, if you took advantage of this today, if you had to go into a retirement home or you had some disability that you need to use the insurance policy, you could receive back up to $9,000 a month as your payout. And I thought, wow, I've had older relatives that I had to help put in assisted living, and that $9,000 a month with them could have gone a long way. So I liked that, so I kept it. And so it's like, I don't know. For me, it's kind of like almost like I'm ready to go for it now, because it's like room service and everybody's taking care of me. Why not? No mortgage, $9,000 a month. So again, other considerations. Let's see what your retirement looks like. Maybe long-term health care is for you. But maybe a reverse mortgage would help. But again, rent can be a little scary when you're doing your retirement age, unless you've got some kind of a good relationship with your landlord. So in conclusion, I just want to let you know, renting can be cheaper than buying a home. Buying a home is not for everybody. If your short-term goals are to be very mobile, I would definitely recommend renting. If your long-term goals are to settle down roots, raise a family, and be a part of your community, definitely buying is better for you. And over time, buying is definitely going to be cheaper than rent. And then you definitely will benefit from the appreciation when you eventually sell your home in the future. So that is my presentation today. I really appreciate you guys hanging with me. And